we'll touch on. I don't think we have time today to go into each one of them, but I hope that we'll be able to put some context around sort of how we see the economy. Certainly, when you start looking at a few of the negative pieces, and remember, when you're doing a jigsaw puzzle, you're working on maybe portions of the corner, the side. You don't really attack the bill because that's something what you might that like for your strategy. Mine's always been the corners and the rail. So think about a few of these pieces being the rail to the right might be housing, and certainly the interest sensitivity of housing that's going on, and certainly backslide. Think about what we just heard last week from the NFIB small business, and I just mentioned to you that everybody thinks of retail as the big guys, but there is a lot. About 90% of retail are small businesses with under 10 employees. So it's a very, very diverse industry. We saw ISM surveys that have come out in a week or so, and certainly showing contraction. And obviously, just recently, last week, we had inflation. Even though inflation is a negative, it can also, as we think about the rate of inflation, is kind of possibly a positive as we think about how the economy might turn out. But on the other hand, consumption was relatively strong. Look at those data points in 2 weeks. Consumer confidence is on the mend. We just got some data from University of Michigan last week that was out of upswing. Unemployment rate is at a 50-year low. We're still growing in terms of jobs. Initial claims are still well below the break-even level. And these are indicators usually that we look at to get signals on the economy. And of course, another point of reference I would just say is, the Federal Reserve raised interest rates 425 basis points last year. And the economy is still doing okay. And in the second half, we raised them 275 basis points, and we still are seeing some strength. So I get a lot of questions, and what about the full story on recession? We'll talk a little bit about it, but just let me put a few of my thoughts together, because I'm regularly asked about it. So what about recession? Well, I can tell you, we'll have a recession. The question is when? Will it be next year? Business cycles repeat themselves. A recession is normal. It's a part of the economic fabric. At this point, I am not in a position to believe that we are in a recession at this point, and I'm hoping that we can get through next year or this year without being disappointed. But they are normal, and of course, the question is when would it happen? And I'll just mention a very famous economist, Paul Samuelson, once said in a D-Week article that the stock market has predicted 9 of the past 5 recessions. So think about, we're trying to determine from the data what roles what data is telling us about the future. And I'm going to say I'm kind of in the camp right now at this point. We'll hear from our speakers on what their view is on the economy. I'm thinking get through it. It's going to be a challenging one. It will have some disruptions. There are flashy lights. You can look at other indicators. For you people who are mindful of the inverted yield curve, it's been inverted since November. It's not the most reliable indicator when it has proven to be at times to be a fairly good one. It doesn't tell us when. It just says we're in a position. It's like a barometer that the weather is changing. And of course, if you haven't read an article just produced last month by the San Francisco Fed, they go into detail about the use of the unemployment rate as an indicator. They find at this time that it does not currently signal a recession. So, Mayor, what scenario is, I think it will be a challenging 2023. I do expect a meaningful slowdown. I am still constructive about the consumer. There still remains a significant amount of cash out there in checking accounts. I think the key with the consumer, I'll break it down very simply. If you feel secure about your job, you probably have confidence about spending. And right now, I don't believe that security is a big issue for 96% of people in the economy. Now, there are certain sectors, there are technical recessions maybe going on. But right now, I would say that we'll have to take our indication for the consumer. And then finally, I do not know what the Fed will do. I know they'll want to avoid fits and starts of the economy like we saw back in the 70s. I think the evidence currently suggests that we are slowing. But ultimately, my view is that we're not in recession at this point. I just have to wait and see. And we'll learn a little bit more from how my colleagues are thinking. I'm going to turn it right to you, Sarah, with your view on how 2022 or 2023 is shaping up.
Great. Thank you for having me. I'm glad to be here. So we're ending the year definitely on a stronger note than expected. We're tracking about 3% GDP growth for the fourth quarter. And it's undeniable that growth is going to slow down this year. We know that the interest-sensitive parts of the economy have started to react, but it takes time for that to move through different sectors. So residential investment, housing activity reacts immediately to higher interest rates, and that's been in quite a bit of decline for the last 3 quarters. Consumption takes a bit longer, and then business investment follows after that. So it's no surprise that consumer spending, we haven't seen a really big pullback in some of these interest-sensitive components of spending quite yet. We would expect that to happen in the first half of 2023, and then business investment would start to follow later in 2023. So we're definitely in for a year of slower growth. We do not forecast a recession in our outlook, but we do have growth slowing to about 0.3% in 2023. I mean, that's a very painful year. That's well below potential, which is about 1.7% growth, and definitely slower than some of the very strong growth that we've seen over the last 2 years. So within that, there's going to be pockets in the economy, as Jeff mentioned, that feel recessionary. Housing activity is definitely one of them. We're seeing layoffs within the tech sector. We're seeing some pull off in hiring for some of these financial services industries that are tied to housing, mortgage originators. But really the silver lining for 2023, we also think is going to be the consumer. We have consumer spending slowing down to about a third of what we saw in 2022. But if you look under the hood, the consumer is still in pretty good shape. Household balance sheets are still very healthy. People have built up a tremendous amount of equity in their homes over the last couple of years. We have seen a sell-off in equities, and people have lost a lot of stock market wealth, but that's very concentrated among the wealthiest households. And we still, as you mentioned, have this tremendous amount of excess savings. And we know households have drawn down quite a lot of their excess savings in 2022. There's a bit more to pull consumers through into 2023. But really what it comes down to is the labor market. And Jack said it well. If you think you're going to have a job, you're going to continue to spend. People are becoming increasingly concerned about the labor market outlook this year. Even though layoffs have been very concentrated in the tech sector, which is only about 1% of total non-farm payrolls in the U.S., so it's a very small share of the U.S. economy. It's in the headlines a lot. These companies have massive market cap, so people are seeing these headlines and taking notice. And so as the labor market slows this year, we start to see the unemployment rise. People, do you think, are going to become more cautious spenders? What does that look like? I think that we're going to, and I'm sure we'll get more into this, they're going to shift their spending behaviors or pull back their spending altogether. But overall, the consumer is what pulls us through in 2023. We're in for a year of higher interest rates for a long time. The Fed had made it very clear that they're going to keep rates at their peak rate for about a year. So that's going to make its way through the economy through higher debt service costs for households, for companies. So it's going to be a tough growth year, but we think that, especially how strong the labor market's been, that's really going to support the consumer for 2023.
Thanks, Sarah. Ken, your perspective, all ears.
Thanks very much, Jack and Sarah. It's great to be here. So on the argument point from KP and Jack Act is that we believe the U.S. economy will enter a recession in the first half of 2023. A lot of the points that Sarah made, we just think it's going to be weaker. I'll start with your quote, Samuelson quote about stock market predicting 9 of the last 5 recessions. Well, from the yield curve, we follow that very closely. And from the perspective of fixed income market participants, what the curve inverted in the yield curve is telling us is that long rates are below short rates. So if you could believe that a 10-year U.S. Treasury note currently yields about 3.5%. Does anyone know what the 1-year Treasury bill is yielding? It's 120 basis points higher, 470%. So you can see how upside down the yield curve is. And that's an anomaly because typically, if you're putting your money at risk, going out all the way 10 years, you want to get some return for that. The uncertainty of investing your money for 10 years. But now you're getting a 1-year return over 1 full percentage point. And just a testament of how COVID had impacted the economy and financial markets, and in a way, how upside down we are, particularly from the viewpoint of the fixed income market for U.S. Treasury yield. Now, going back to Jack's earlier quote about Samuelson, when you look at the yield curve, particularly the spread between 3-month and 10-year yields, and that has the longest history. So if you go back to 1962, there's been 9 inversions in the yield curve. Anybody take a guess how many recessions we've had in the U.S. economy? 7, we're in 9, 8 times. So a much better track record than the stock market. So that's one of the reasons that the signal that we're receiving from the fixed income market has us concerned about where the U.S. economy might be headed. Yes, Jack's entirely right. We don't know whether the recession might arrive within a couple of months, or it could still be a year out. So that is a long time span, but we do think economic activity will weaken. We do expect negative GDP in both Q1 and Q2. For Q1, we're looking for down 2% GDP growth. Q2 down 1.6, so 1.8 decline for the first half. But second half, we do expect a recovery. And another data point that we've been following closely is actually soft data. Recently this week, Philadelphia Fed President Patrick Harker had commented that sometimes the hard data doesn't tell you the full story. And at times, it's important to look at soft data, which is survey data. And the importance of survey data is it captures changes in sentiment much more quicker than the official statistics. And as Jack had mentioned, the PMI, Purchasing Managers Index for services in December actually fell below 50. 50 is the break even. If you're above 50, economic activity is expanding, below 50 is contracting. And for the services PMI, it kind of informs us that, the layoff occurring in tech, financial services, residential housing, that may be starting to broaden into other areas of the economy because of that PMI going below 50. So those are some of the concerns that we have.
Let's talk about inflation for a minute. Where do you see inflation going through 2023? Because that's going to be a big factor, has been a big factor. And we know the Fed is very concerned about it. Ken, what do you think the direction is over the next 12 months?
We do see progress on inflation. The most recent CPI report for December, 6.5% annual rate, which is down from 7.1 in November. And then the peak was 9.1 back in June of last year. So we've made measurable progress. For the balance of this year, let's say December 2023, Carl looking somewhere at 3 to 3.5% CPI. We're not going to quite get to 2% that quickly. It's always kind of that, last mile problem, which retailers have. That's usually the toughest part, getting that efficiency at the last mile. So getting to the 2% target, I think, will be a little bit longer beyond 23. But we do expect continued progress on the inflation, but the Fed is not done yet. They're still going to keep raising rates.
The follow-up column here, you're looking for a soft first half, right? And ultimately, GDP for the year will be negative.
It will be negative on a Q4 basis, but actually on an annual average, it'll probably be up 0.2 because we do expect a recovery in the second half.
And your thoughts on this?
Yeah, we have inflation coming down to about 3% by the end of 2023. Similarly, not getting back towards that 2% range till the end of 2024 or beyond. And we don't have the Fed considering reducing rates until we're at that 3% range. So
what brings the rate down, though? Right now, it's elevated. Your expectations are for one issue bring to mind is certainly rental costs. Rents are high, but my view is they're expected to fall off as the year goes further because the price of homes have coming down. And if you know how the CPI and the PCE calculates, they impute owner equivalent rent that comes from changes in home prices. Everything I'm reading and seeing and hearing is that could be a major issue for inflation to come down. And your thoughts?
so I think it's really important when thinking about inflation is to break out services versus goods because they're completely different stories right now. A lot of us been driving goods inflation has been driven by supply chain disruptions. 80% of those prices that we saw during COVID came from new and used vehicle prices. And used vehicle prices were up 55% at their highest peak. On the other side, the services is a much more reflective of aggregate demand in the economy. That's also why the Fed is a lot more focused on core services because it's is more of a reflection of the response of the economy to higher interest rates. Within goods, we expect a lot of deflation to come from vehicle prices. Apparel prices have come off a little bit, home goods, but because 80% is motor vehicles, that's going to do a long way in bringing down overall inflation. We've already seen used vehicle prices declining month over month for about 5 or 6 months, and new vehicle prices, which tend to lag used vehicle prices, just turned in the latest print as well. And then, as you mentioned, shelter inflation, that's very tied to the labor market. So as job growth slows, as wages slow, we are going to see that pass through into shelter inflation coming off. And we know that home prices have come down. New rents are starting to roll over, and that just takes time based on methodology to show through into inflation. So we would expect shelter to roll over more notably in mid-2023.
Any comment, because I'm going to pick on something that you just mentioned, employment growth. With the degree of in downturn that you're expecting, Kat, I'm assuming you're seeing negative average monthly growth in employment. Can you give us an approximation and will we see that? We had very strong, I shouldn't say very, we had solid numbers for November in the Sabbath corporate account.
Yeah, and I certainly agree that the labor markets remain still solid in the U.S. economy. There were some signs of cooling on the edges in the labor market. For example, the number of job openings is still very high for the U.S. economy, just over close to 10.5 million. At the peak, there were 12 million job openings. So just to put that into perspective, if we translated our current unemployment rate, which is 3.5%, a 50-year low that Jack had mentioned earlier, that 3.5% would translate into about 5.7 million people unemployed in the U.S. economy. So